Have you ever approved a project just because it felt like a great idea, only to watch it, well, fizzle out? Yeah, we've all been there. Look, passionate pitches and good ideas are great, but they're not enough to build something that lasts. So today, we're going to open up the essential toolkit every leader needs to stop guessing and start making investment decisions that actually create value. Here's the game plan. We'll start with the big idea behind return on investment. Then we'll look at the tools you're going to use, see them in action with some real-world examples, and give you a practical playbook. We'll wrap up with some common mistakes to watch out for and a really clear call to action. Okay, let's get into it. So picture this. One of your sharpest team members comes to you just buzzing with energy. They're pitching a $50,000 software upgrade, and they promise it's going to completely revolutionize their team's workflow. I mean, it sounds amazing. They're so passionate. You want to empower your people, right? So you give them the green light. Okay, now fast forward 6 months. What's happening? Well, the team's adoption of the new software is spotty at best. Those promised efficiency gains, you can't see them anywhere. And that $50,000 bucks? Poof, it's gone. The passion was real, for sure, but the plan was based on a vibe, not on value. And this is such a common pain point for leaders, but there is a better way. And that brings us right to the big idea for today. It's all about making a shift in our decision-making, moving from vibes to value. The tool that helps us make this shift is called return on investment, or ROI. Now, don't let that term scare you. It's not just some complicated formula for your finance people. For a leader, ROI is really a framework for thinking. It's a way to ask one single critical question before you spend a dime. And this is that question. If we invest this money now, will we get enough cash back soon enough to justify the risk? Seriously, every word in that question matters. It forces us to think about 3 things: the actual cash coming back, not just vague benefits, the timing of that return, and the risk that's built into any plan. So how do we actually answer that question? Well, let's open up the toolkit and look at the 3 main ways finance pros figure this stuff out. First up, you've got the payback method. Super simple. It just asks how fast we get our initial investment back. It's a great first sniff test. But, and this is a big but, it completely ignores any money you make after you break even. Next is net present value, or NPV. This one is the gold standard. It answers, what's this whole project worth in today's dollars? See, a dollar today is worth more than a dollar next year because you can invest it. NPV does all that math for you. And finally, there's internal rate of return, or IRR. Think of this like the project's interest rate. It gives you a percentage. So to put it simply, payback is all about speed. IRR gives you a score. But NPV tells you the real value. Now that IRR score, what do you compare it to? You compare it to something called the hurdle rate. This is basically the high jump bar for your projects. It's the minimum return your organization says a project has to hit to even be considered. If the IRR is below the hurdle rate, it's out. Simple as that. Now here's where it gets interesting. Sometimes these 3 methods can actually point you in different directions. You might have one project with a faster payback, but another one has a higher IRR. So what do? Here's the key. When in doubt, your tiebreaker is always net present value. NPV tells you the straight-up value a project adds to the organization in today's dollars, and at the end of the day, that's what really matters. But listen, if you only remember one thing from our time together, let it be this. The magic is not in the formulas. It's in the assumptions that feed those formulas. Your real job as a leader isn't to be an accountant, it's to be the chief reality checker. Okay, enough with the theory. Let's see how this stuff actually works in the real world. We'll look at a business scenario and then apply the same thinking to a ministry context. Let's go back to that $50,000 software upgrade. A financially smart leader starts asking questions. Okay, what if only 60% of the team actually uses this thing? Did we account for the 40 hours of lost productivity when we're training everyone? See how the questions change? It's not, is this a good idea? It's, what has to be true for this to be a good investment? The same exact logic applies to a ministry launching a new campus. The vision is beautiful, right? But good stewardship means we have to ask, are these giving projections based on data or just hope? What are the hidden startup costs we haven't thought about? What's a realistic timeline for this campus to support itself? So what can you actually do with this tomorrow? Here's a super simple playbook, and I'll break it down for you whether you have a finance team or not. Okay. If you're flying solo without a finance department, you need to build 3 habits. First, force every proposal to be talked about in terms of cash flow.
No more vague benefits. How does this bring cash in or reduce cash going out? Second, use that simple payback calculation as your first tough filter. If a project can't even pay for itself, it's probably not worth your time. And third, and you know I'm going to say it again, always, always ask about the assumptions. Now, if you're lucky enough to have a finance team, your job changes a bit. First, for any big decision, ask them to show you the net present value. It just forces the most disciplined conversation. Second, ask about your organization's hurdle rate. Is it still the right one for your strategy today? And finally, use your team's on-the-ground knowledge to push back and challenge the finance team's estimates. They've got the numbers, sure, but you know the reality of your operations. All right, to wrap things up, let's just quickly cover a few common traps that leaders fall into, and then I'll give you one concrete action you can take this week. So there are 3 big traps to avoid. The first is what I call the spreadsheet trance. That's when you're staring at this beautiful, complex spreadsheet and you start to think the numbers are facts. They're not. They are guesses. Educated guesses, hopefully, but still guesses. Second is the seduction of IRR. A 50% return sounds incredible, but if it's on a tiny little project, it might be way less valuable than a 15% return on a huge strategic move. Don't let a big percentage distract you from the actual value. And finally, watch out for the payback trap. A project that pays for itself in 1 year looks fantastic, but it might be a terrible long-term investment compared to one with a 3-year payback that keeps generating cash for the next 20 years. At the end of the day, using this kind of discipline isn't about being a cold, numbers-obsessed robot. It's really an act of stewardship. It's how we protect our mission, our people, and our resources from the very real danger of costly enthusiasm. It's about grounding our vision in the wisdom of counting the cost first. So here it is, your call to action. Sometime this week, I want you to pick one project, one proposal, one idea that's being kicked around, and just ask this one simple question. What are the 3 biggest assumptions we are making about the cash returns from this investment? I promise you, that one question will completely change the conversation and get you on the road to true financial intelligence.